Hello dear students, welcome to Devika's Commerce and Management Academy. Holding companies, today we will see one problem which is related to the pre-acquisition profit, post-acquisition profit. Very interesting and also important problem. So how we can treat it? By the way, so far whatever we have done the problems, are you thorough? If yes, then only come to this problem. Basic clarification which is much required. Now anyhow problem is given in the desktop. You can take a screenshot or note down. Okay, first I'll read the problem, then I'll explain it, then we'll go for the problem. The problem is given like this. Excuse me. H Limited acquires all shares of S Limited on 1/10/2003. H Limited holding company acquires all the shares of S Limited. S Limited is here subsidiary company. On 1/10/2003, mid of the year, 1st October, okay? And from the balance sheet given below, prepare consolidated balance sheet. We have to prepare the consolidated balance sheet. Balance sheet date is here 31st March 2004. Where acquiring the company is 1/10/2003. It means October 1st, October, November, December, January, February, March, 6 months. Whenever you find this kind of differences, they are acquiring in mid of the year and where the balance sheet is given 31st March, during these two periods, whatever months are there, so those months will be calculating acquisition of pre-acquisition, post-acquisition of profit. They don't say anything. We have to identify. Please be careful while reading the problem itself only. Now here as per the problem, we are finding two different dates, means post-acquisition, pre-acquisition profit we are going to calculate. Just remember this point. Anyway, we are going to do the working notes. Now the problem is given here, balance sheets on 31st March 2004, H Limited and S Limited. We'll see first liability side. Share capital, shares 10 rupees each, 5 lakh and 2 lakh. And reserves on 1/4/2003, 2 lakh 50 and 50,000. 2,50,000 will be showing in the balance sheet under the column of reserves and surplus. Reserves and surplus comes under the share capital. Capital there, no? So there we are going to write. What about this 50,000? 50,000 is here capital reserve. Capital reserve always deducted from the calculation of goodwill or capital reserve. We'll be calculating goodwill or profit capital reserve, no? Goodwill or capital reserve. There we are going to deduct it because this is a capital profit. Always remember it. So always remember, capital of the holding company will be writing into the balance sheet under the column of reserves and surplus. Now the reserve of the subsidiary company, this always will be deducting from the calculation of goodwill or capital reserve. We'll be doing capital calculation of goodwill or capital reserve. There we are going to deduct it because it is a capital reserve. Point to be noted. Next, profit and loss account. Profit and loss account also here 80,000, 40,000. Holding companies 80,000 will be showing in the balance sheet. Okay, and we'll be adding to the reserves and surplus this 80,000. And 40,000 we are not going to take it into the balance sheet. This 40,000 will be calculating for pre-acquisition and post-acquisition of profit. Okay, please remember this 40,000 we are going to calculate for pre-acquisition and post-acquisition profit according to the dates are given. October 1st to 31st March. 6 months we are getting. So there we are going to use this 40,000. Creditors is, trade payable under the column of trade payable in the balance sheet you'll write. Now coming to the assets, we have only two items. One is sundry assets. Sundry assets is nothing but fixed assets. Fixed assets will be showing it as tangible asset in the balance sheet asset side. Next, S Limited shares. How much shares they are buying it? 3 lakh shares, 100% shares of S Limited. S Limited shares, H Limited is buying. How much shares they are buying it? 100% they are buying. 100% they are buying means there are no outsiders. There is no minority interest also. Whenever you find something is invested by the holding company, the rest of the something will be minority interest, but here 100% investment by the holding company. What is the investment they are putting? 3 lakh rupees. Actual cost or the share capital value is here. If you see on the liability side, S Limited share capital is 2 lakh, but they are paying 3 lakh rupees. We have some adjustments also. We'll do the adjustment, then after that we'll come to know whether it's a goodwill or capital reserve. Now, end of the problem. The profit and loss account of the balance sheet is the profit made in the year 2003 to 2004. Profit and loss account means always last year's only. Though they are not mentioning this point, it is understood. Clear? Now coming to the problem. Working notes already I have done. Let me explain it very clearly. First thing is that we need to calculate the pre-acquisition, post-acquisition profit. Pre-acquisition means before acquiring the company, profit whatever we are getting pre-acquisition. Post-acquisition means after acquiring the company, after taking over the company, profit, that we say it as a post-acquisition profit. Pre-acquisition, post-acquisition. How do we calculate that? First of all, we know that profit and loss account S Limited, that is subsidiary company limited, profit and loss account amount is 40,000. This amount is we are going to divide. Okay. So this 40,000. What is the period? 1st October 2003 to 31st March 2004. Okay. This, if you calculate 6 months, we are getting October, November, December, January, February, March. So 6 months. 6 months. 6 months. First 6 months are pre-acquisition. Next 6 months post-acquisition. So the same thing we are calculating here. Pre-acquisition profit 40,000 into first 6 months. This comes to 20,000. Post-acquisition next 6 months. So that is also 20,000. Pre-acquisition, post-acquisition. How do we handle it? How do we handle it? Please be careful. Whenever you find pre-acquisition profit, this has to be deducted while calculating the goodwill or capital reserve. Why to deduct it? Because already we received some profit, pre-acquisition profit. We received. So this is to be deducted from the capital, or sorry, this is to be deducted from the goodwill or capital reserve. Why should we consider? That is why we are deducting. Already we have received. We received already, so that we have to deduct it from the goodwill or capital reserve calculation. Second one, post acquisition profit. This we are going to add, means we are going to receive. Second one is we are going to receive. So this is pre-acquisition, we have deducted. Now post acquisition we are going to get, that is why we have to add. To where we have to add? We have to add to the reserves and surplus. Add it to the reserves and surplus. Pre-deduct it while calculating the goodwill or capital reserve. Post, always add to the reserves and surplus. These 2 points, if you remember, rest of the problem is normal, simple. Are you getting it? Now, this is over. Next, we know that there is a goodwill because shares are 3 lakh rupees. Share value is 2 lakh rupees. How much we are investing? 3 lakh rupees. Means there is a goodwill. Goodwill is there. So that goodwill calculation we are doing. Calculation of goodwill or capital reserve is the common heading we keep. So I kept a heading. What is the cost of the investment? You know, it is given in the problem, that is 3 lakh rupees. Our investment in the balance sheet asset side, it is given 3 lakh is our investment. What is the value of the shares? That is paid up share capital, which is given in the balance sheet liability side, 2 lakh rupees. Value of the shares. This we have to deduct it. We know it very well, this one. The difference between these two will be generally goodwill or capital reserve we are going to get. Now there are some adjustments. What are those adjustments? One is pre-acquisition profit. Here I said pre-acquisition profit, calculation of good capital or goodwill. So there we are going to deduct pre-acquisition profit. So deduct pre-acquisition profit. How much? 20,000. And also there is a reserves. Reserves of how much it is? Reserves of 50,000. So 50,000 also we have to deduct it because it is a capital profit. So 50,000 also deduct it. Both the amounts if you deduct, means altogether it is coming to 2,70,000. So amount is here 30,000. 30,000 is the goodwill. How do you say goodwill? The total investment is 3 lakh, but actual value is here 2,70,000. Share value is 2,70,000. If you take all these amounts, okay, altogether 2 lakh plus 20,000 plus 50,000, altogether the value is here 2,70,000 share capital value, whereas we are paying 3 lakh, more than the value we are paying, that is a goodwill. So we got a goodwill of 30,000. Did you understand these two calculations? Pre-acquisition, post-acquisition profit. How do we divide and how do we consider it? Okay. Up to here, if you are clear, then we'll go to the balance sheet, consolidated balance sheet. Format already I have written same as it is, no changes at all. Now if you see the problem, first share capital. Share capital is here 5 lakh. Share capital we can show it in notes. Share capital, each share is 10 rupees. Total amount is 50 lakh. 5 lakh means how many shares are there? 5 lakh divided by 10. 50,000 shares. 50,000 equity shares at the rate of 10 rupees. This is 5 lakh. This is to be written here. Share capital, point number 1, 5 lakh. Then after that, second point is reserves and surplus. Reserves and surplus, note number 2. So here we have done some working notes. How do we calculate? I need your attention. Reserves and reserves are here. It is given 2,50,000. First we have written 2,50,000. We know that pre-acquisition is to be deducted while calculating the goodwill or capital reserve. What about the post-acquisition profit? That is to be added to the reserves and surplus. Why we have to add? It's a profit. Profit always to be added to the reserves and surplus. So I'm adding here first post-acquisition profit 20,000. This one added, and also there is a profit and loss account 80,000 is given. Which company? H Limited holding company. 80,000 profit and loss account is given. This 80,000 is company's profit added to the reserves and surplus, right? So I have added profit and loss account of H Limited 80,000. Altogether we are getting 3,50,000 reserves and surplus. Are you getting simple? We didn't do anything. Only the thing is here post acquisition profit we have added, and profit and loss account which is given in the balance sheet liabilities side, that 80,000 we have added. Altogether we are getting 3,50,000 is the reserves and surplus. Note number 2. 3,50,000 will write here. Minority interest is there? No, because 100% investment by the holding company. So there is no minority interest. In the same non-current liabilities also, long-term liability it is not there. So nil it is. Next, current liabilities. Current liabilities we have trade payable only we can write. Trade payable means here creditors. This is point number 3, trade payable. Point number 3, trade payable, how much it is? 70,000, 10,000. It is 80,000. So 80,000 will write. If you want, you can write separately also. Trade payable. Trade payable. H Limited 70,000. Separately you can write H Limited 70,000, and in this is equal to the next S Limited 10,000. So you can show it like this also. In shortcut I have written like this. You better to show it like this. So anyhow trade payable is 80,000 we have written. So with this liability side is over. How much we are getting? 9,30,000. Now let's focus on the asset side. Asset side, first thing is tangible asset. Okay, tangible asset. So this is showing in the working note 4, tangible assets. Tangible assets also in the same way you can write. H Limited is how much? 6 lakh. S Limited is 3 lakh. 6 lakh plus 3 lakh it is 9 lakh. 9 lakh will write here. Tangible asset. Intangible asset. Intangible asset means goodwill. Goodwill, where is goodwill? We have done already calculation. Goodwill is 30,000. Once again, we have mentioned intangible asset. No, this is so intangible asset. Yes, 30,000. And next, current assets. Inventories, trade receivable, cash and cash equivalent, other current assets. Anything is given? Not at all. So we'll keep the blanks. That's it. 9,30,000. Tallied, problem got tallied. Very simple. Only simple thing is you have to remember pre-acquisition profit, post-acquisition profit. Pre-acquisition means always you have to deduct from while calculating the goodwill or capital reserve. Post-acquisition means you will be adding to the capital, reserves and surplus. Add to the reserves and surplus. This one, deduct it while calculating the goodwill or capital reserve. Simple. And calculation you must be knowing very well. You must be thorough. That's all. Simple problem. Take a screenshot. Hope it is clear. With this, we are winding up holding companies. Work out more problems, not only what I taught you, basic problems I taught you. You work out more problems so that you get the more clarity. If any doubts, write down with pencil. So neatly you prepare a notes. So it will be easy for you to understand the subject, and in examination your hand goes like flawless. Practice well. Don't forget to share these videos. Check out the playlist. Whatever is required, use it. And practice well. Good luck.